like your dad. He's not flying by this. I take comfort when I get on an airplane that he's not just making emotional one-off decisions about the direction, the location, the land, like all of that kind of stuff. It's process driven. And that's again, that's why our client, that's why advisors are so important in the ecosystem of the investment process, is because they do that. They are in many ways a pilot for their clients and helping manage the risk within the investment world.
Hey everybody, welcome to this week's NASDAQ Dorsey Wright podcast. Special guest Jay, you used to be on here like every week, I think. When I was an intern.
There was a period of time.
Yeah. And Jay's been with us, 20 years essentially total?
More or less. Close to that. Yeah. So I started my career at Dorsey Wright in 2005, and for the better part of the past, call it 18 years now. Have been here as part of the family. So
perfect.
Good to be back here.
Yeah. Thanks for being on the podcast. Jay's on for a great reason. We're doing a 4-part series on risk, which we know is pretty arbitrary, like pretty vague at first thought, but there's a lot of things, a lot of directions that we want to take the conversation, kind of set up this 4-part series. But before we get into those, like some of the specifics, we were talking before, when you just hear the term risk, what's first thing comes to mind?
So it's interesting you asked that, and I'm gonna go a little bit around about answering the question, because when you ask me the word risk, and when I think about it in the context, my mind went first to the stock market, and the first word that came to mind or phrase that came to mind was standard deviation. And that is probably less than 1% of people, when they hear the word risk, that's where their mind goes. But that's kind of where my mind went. And then we took a step back a little bit and thought, okay, risk is not just standard deviation and numbers and all that kind of good stuff. But the initial reaction, if we were playing a game, tell me the first thing that comes to mind, it was standard deviation. It was, how volatile is this stock or this sector, or this asset class, or this market in general? But I know that's not the standard out there. But I think when a lot of people hear the word risk, hear the words standard deviation and volatility, it's a negative connotation that's attached to it. And it's not necessarily always has to be the case. But that's when you asked, all honesty, that's where my head went.
I love that answer for a lot of reasons. There's some really good jumping off points. And I was just thinking too, like with the term standard deviation, you're deviating from an expected norm. Right. You're deviating from some type of expectation,
which is scary.
Yeah.
Like in not just the market, but deviating from what is comfortable or normal to most people. Forget the market for a second. And I mean, our day-to-day lives, if I deviate from something normal, it's not necessarily comfortable. It's not that it's a bad thing. But it's if you start to go outside of comfort levels, it gets to be uncomfortable for a lot of ways.
And the uncomfortability can create a positive effect or a negative effect, like we were talking about before with standard deviation. If your expectation is here and you're 2 standard deviations above what you would expect, or 2 periods, whatever, higher or lower, there's really different outcomes. So there's a positive way to view risks, like the risk reward coin, typically greater risk, more reward, lower the risk, lower the reward. So there's, like I said, there's a lot of different, I think, avenues that you could take, like when risk first comes to mind. And then we'll talk about later on the series, like when our clients, our partners, when they hear risk, what comes to mind. I think something we want to talk about too is that neither of us thought of risk as reflective, because I would say the biggest risk in my life can be myself. Sometimes in my investment process, probably myself. I don't know if you relate on that or not.
100%. And you're right. It's not the first thing that came to mind, but when you think about it, it 100% is. And, just as an investor in general, the emotional attachment to investments can be the biggest deterrent to gains or losses within a portfolio. Whatever that investment might be. And there's a lot of studies out there. If you're familiar with the Dalbar study.
I am now as a few minutes ago,
But that's one that's been published for years and years and years, that just talks about the performance of the market, the performance of average investments, and the average performance of investors. And perpetually investors underperform because they are making reactional, emotional investment decisions. They're buying the best performing things, they're selling the worst performing things at the wrong times, and emotions come. And it's a real thing, right? You think back to like the '08 stock market bear market in '08, and the natural reaction as you see things going down and getting the worst is to sell out at the bottom, because that's when things feel the worst. And then the human intuition is like, oh, things are good, I'm going to buy things at the top. And that's human emotion. And that's where, and we talk about it all the time, and we talk to financial advisors day in and day out, multiple times a day. And that's one of the biggest benefits that investors can see and reap from having a financial advisor, is helping mitigate and manage that risk. We talked about earlier, you're not getting rid of risk. Risk is going to be with us whether we like it or not in our investment process, in our day-to-day lives. But if we can have a way to help mitigate and manage that risk, and that's, our clients we talk to all the time, they do a phenomenal job of helping clients manage risk within the stock market, and then ultimately, hopefully helping manage risk outside of that.
Yeah, managing emotions, I don't think can be overstated. Like the importance of managing emotions. You gave a really good example before. So my dad's an airline pilot, as you said. Yeah, he flies for Alaska. He's been there for 33, 34 years. And getting on an airplane, there's some risk there for sure. Just thinking about it, being in the metal tube, 30,000 feet in the air with two people, flying.
I try not to think about it too hard.
Yeah, you've probably been on 150 this year. But like there's a lot of risk there.
Sure.
And like you brought up a great example of, they are mitigating that risk by having a thorough process of all the checks you have to do before you take off, all the checks you do once you're in the air, and then the checks you do once you're coming into the airport. You're talking to traffic control. So you're having guidance, you're having sound guidance from others, and sound guidance through a process the whole time that mitigates that risk and keeps it, within expected norms, and you have good expectations for what's supposed to happen. So I think it's a great point for advisors to do that for clients as well.
I'll share a quick story because you mentioned when things are normal. Well, sometimes things in an airplane happen that are not as normal. And I don't even remember what airport I was flying into. But we were landing gear came down. You heard all the noise. Flight attendants were putting everything away, seat backs up, tray tables. We're landing and the plane's going down like this. And then all of a sudden we're not going down. We're now going back up. Well, I was counting the number of planes on the runway, right? And we go back up and we circle back around, and
so you touched ground.
Didn't touch ground. Okay. No. We didn't touch ground.
Landing gear came
down. We were about to touch down.
Okay.
And then the plane started doing this and went straight back up. And the pilot came on as cool as you could imagine. He was like, sorry about that. This is, very normal in our world of, there was traffic on the runway. Things were too close. Air traffic control told us, if you're not this far away, then you got to pull up and keep going around. At any rate, there was very much a process to how that plane was supposed to land. And if it didn't, then there was a default. Hey, if A happens, then we need to go over here to B. And the pilot was like, it's very normal in our world for this to happen. And I've had it happen 1 or 2 or 3 times before, but my guess is a lot of people have not, and that was not a normal thing to happen to them. But that's a risk that a pilot knows, that it's an unknown risk to the passengers, but there's still a process behind it. They know how to handle and how to deal with abnormal circumstances in a very process oriented way.
That's a good example. I've never had that happen to me, so I cannot relate, but I'm sure my dad's done that 100 times.
I'm sure he has. And they, there's trainings for it and all that kind of good stuff, I'm sure. But it is, and I kind of, a lot of stuff that happens, it reminds me of, the market and the process and I like our strategies, and I'll bring it back to the market for a second. Like, our strategies are systematic and process oriented for the very reason we started off talking about is emotions come into play. And if that happened as a pilot and he's got to make an emotional reaction, maybe he makes the right decision, maybe he doesn't. But what's the risk of not making the right decision?
Right.
Within our models, they're systematic, whether it's a stock model, whether it's an ETF model. If something falls below our sell threshold, it's coming out. You and I don't get to sit there and say, geez, I don't think this is the right time, or I don't. No, it's coming out, and we're buying the next highest thing in them, and it's very process oriented, very systematic. That obviously a momentum strategy, relative strength in general, the performance factor over time works very, very well, based on all kinds of research that has been done. But it's about adhering to the process that makes it work over time. It's removing the emotions that help manage the risk within that portfolio.
That's really good. I was thinking too, with the example of what's normal for people changes. So what's normal for you and I in the market, as you've been working in the market obviously much longer than I have, but both of us studied a ton of market history, and our models, our strategies have studied tons of market history. So they know what's normal. They can kind of feel out systematically what's normal, what's not normal. But for clients of an advisor, like just starting investing, or people near the end of retirement, like market doing what it's doing this year may not feel that normal, or market doing what it did in 2022 may not feel that normal. So having somebody with a process that can manage emotions, I think is like paramount to 100%, any successful
100%. And a process in investing is so important. But there's other aspects to it, like having a process and a discipline. You're way better about it than I am, but think about exercise, working out. Like if you don't have a process or a system to do that,
I'm seasonal.
But if you have, goals that you're going for, if you have, you're working towards those goals. And again, that's, let's say I've got a half marathon that I'm supposed to run in March. Well, it's almost November, so I got to start right. But that's the goal. And just like an investor, they have a goal of retirement or buying a home or whatever that goal is. That's where an advisor helps that client manage the risk to get to that goal, because you're not avoiding risk. Risk is all, and being in 100% cash is a risk. It might be an opportunity risk. If the market goes up, you might not participate on the upside. That risk is dampened a little bit now with rates where they are versus where they were, say, 4 or 5 years ago.
Right.
But it's still a risk. And so, but the risk of the process, or managing the risk with a process is just key.
Yeah. I've had a lot of conversations over the past 2 or 3 years, I'm sure you have as well, with even just strategy risk, like model risk, investment risk of, we've seen this work point A to point B over 10, 15 years. Great. But your actual experience as an investor from point A to point B is equally important, because there's so much risk along the way that somebody bails. Like you brought up that was a Dalbar study or something like that, where there's so much risk along the way of the model's too volatile. Somebody bails and they can't stick with the process for the whole time. So it's like the importance of having a process, and then also making sure that process is followable, and it's realistic, it's practical. It's not something that you have to just close your eyes and wait for 20 years and try to hold on to.
Right.
And I've had a lot of conversations with that. We've got that new custom model tool on our system. Like everybody loves back testing stuff, and they're like, oh, it looks great, but they're not seeing that intra-period experience of down 30, up 20, down 10. And who knows if somebody can hang on for that type of ride. I was say too, like, and you mentioned that risk is unavoidable. You've seen so many products come out now, like buffered products that are trying to minimize that downside risk while giving you enough upside. But there's no free lunches. Like you said, there's an opportunity risk out there. Pretty much regardless in the market. So as an advisor, we've learned, and you share, like, it's really about kind of shifting risk and assessing, like, is this an appropriate risk? Do you have the willingness and the ability, or do you just have the willingness and you're actually not able to bear?
Yeah. A couple of things there. You talk about like our strategies and models, and there's periods where relative strength or momentum is going to underperform. And that's just, by definition of nature, right? In order for stuff to move into models, it has to outperform. In order for stuff to rotate out, it has to underperform off the top. When it breaks down is when you're not disciplined to the process, right? That's not to say doesn't underperform, but when the strategy breaks down, it's because you're not disciplined to the process. The strategy, if it's underperforming because things are rotating, that's what we would expect with a relative strength strategy. No different than, if you're a value investor. Like value investor, there's Warren Buffett is a phenomenally famous value investor, but there are stretches where value investing underperforms. But if you start, and I go back to the past 5 to 6 years, 10 years probably, and then you go back into the late 90s, the stuff that was working was large growth, right? The value stuff was not working. And if you were a value investor during the late 90s leading up to you just massively lagged the market. But when you saw very bright and disciplined value investors stuck to their process because they know that over the long run it's going to work. And that's why things like momentum or relative strength that is driving our strategies and a value investment process, those two things work very well together, right? They're complementary investment processes within a portfolio. And that's why when we talk about, you and I are talking to advisors, whether an individual product or strategy, pairing our strategy or model with something that's a value grounded strategy, those two things work very, very well together because they do very well over the long run. And when they don't do well, it's typically at different points in the cycle. And so you have this kind of yin and yang. I think back to a sandbox, like they play well in the sandbox together. Nobody plays in sandboxes anymore, I don't think, but that's that they pair well together. And so when you're going through those conversations, that's where it's like, look, if this is not working, this is typically working, and vice versa. And so you get the benefits of the negative correlation of excess return.
There it is.
There it is. That's the playing well in the sandbox analogy, but you get the benefit of those two strategies that just they perform very well over time, perform very differently at different points in the cycle. And when you're putting portfolios together, that's a great way to manage risk is combining a momentum relative strength strategy with something like that's more value oriented in that process. So
that's a great practical example of how to manage some of the strategy, investment risk, even manage some of that business risk. Business risk being just keeping people invested. And for managing that risk, you're going to have to give up something on the upside. So you're taking lower risk of, prolonged periods of underperformance. Because if you just took value by itself or just took momentum and relative strength by itself, point to point, they're probably going to do a little bit better than combining them two together. But that combination is so much smoother. If you want to call it risk adjusted returns, are so much better. So that investor experience is worth it.
Sure. I guess. Well, and the reality is nowadays, you can log in intraday and see what your account's worth, right? That's the
blessing and a curse.
Right? And so you can see that day to day. So the managing the expectations, the managing the investor psychology and the emotions is a very real and very important thing in this day and age.
Yeah. Well, we're like we said earlier, we're going to have 3 more podcasts talking about some other ways that we see our partners, clients thinking about risk, mitigating risk, managing risk. Yeah. But I think we've kind of emphasized today our main points, kind of high level of the risk process and how we see it at a firm level, how our clients are probably experiencing it. Anything else you want to tack in before we?
Yeah, I mean, we could have a conversation for hours, about this and just in general. I think, the big things when we were talking about risk, the one thing that always comes to mind is it's not avoidable.
Yeah.
But it's manageable. And that's the biggest thing. And it's more easily managed with the process. And I think that's just, the big takeaways of, as we were kind of talking and thinking about it this morning, managing risk with a process just is a much more desirable position to be in than, for lack of a better word, flying by the seat of your pants. like your dad. He's not flying by this. I take comfort when I get on an airplane that he's not just making emotional one-off decisions about the direction, the location, the land, like all of that kind of stuff. It's process driven. And that's again, that's why our client, that's why advisors are so important in the ecosystem of the investment process, is because they do that. They are in many ways a pilot for their clients and helping manage the risk within the investment world.
Yeah. Well, that's a great summary. I don't need to add anything to that other than just a quick conclusion. I'll say, appreciate the time.
No, great. Thanks for having me. Great to be here.
Yeah. Maybe we'll try to get you back.
Let's do it again.
Yeah. You passed. You did a good job. Knock the dust off. No, it's good. So no, honestly, thanks everybody. Thanks, Jay. Appreciate you coming back on.
Yeah.
We will be back later this week with the Second Risk Series podcast.